let's get stuck into today's conference. I've got a fantastic lineup of precious metals investors here, and we're going to be tackling the bullish mood around precious metals and gold. And I wanted to start perhaps by saying, is this bullish mood going to continue, and what have been some of the macro drivers around where we see the gold price at the moment? What's been going on in the last 12 months has sort of driven the sentiment around precious metals. George, perhaps you'd like to start us.
Does this work? Yeah, we're good. Thank you very much. I think the root cause, we would say, is uncertainty. And then I qualify that by saying, the future is always uncertain. And so it's very dangerous to say, things are really uncertain, because when you look forward, they always are. But I think if you look at the both political and economic situation globally at the moment, there are a lot of uncertainties. Clearly, we've got the rise of populism politically, and we've seen protests in many countries, which is clearly worrying people and how that's going to play out. And clearly, economically, we have a lot of uncertainty. One, we're still recovering, dealing with the issues from the financial crisis, but we also have major changes in the automotive industry, which has big structural implications, and clearly there's still concerns about Chinese growth and the trajectory of that. So, and if you look at uncertainty indices, of which there are several, most of them are showing record levels of uncertainty over the last 20 years. And that, I think, fundamentally is what's certainly helping gold. It is a hedge against uncertainty, and uncertainty economically, politically. Interest rates are held low. All sorts of things come from that. But I think it's really, things are very uncertain.
So sort of safe haven credentials are pulling money back into gold, or is it not flooded in just yet, or is it just doing good things for the price?
No, we've seen the price move up this year, gold itself and equities, and that is, clearly money coming in. I think it's coming in, has been now for 2 or 3 years. And we continue to see that. And directly in my funds, we saw some profit taking this summer, not surprisingly with the move in equities, but more recently we've seen it coming back in again. If you talk to the companies, and even the big companies, they go, we see you specialist funds, you're always there, but we're seeing more and more generalists come and talk to us. But they're not all there yet. Right. And you talk to Mark Bristow, he'll say it openly. He said, I don't really need to talk to you specialists, you're quite small. He said, I'm after the generalists, and that's who I want to go for. And that's one of the reasons he merged, and that's one of the reasons he wants to be bigger, is to attract that bigger audience.
Yep. Okay. Angelos, what are your thoughts on the macro picture at the minute?
I have to qualify that I have been a gold bull for a very, very long time. And we expanded our investment activities and launched a specialist gold fund in 2009 after the financial crisis, specifically because gold has the safe haven appeal. And it did extremely well up to 2011. We saw the highs of 1927 per ounce on the fear trade post the financial crisis. And then came the massive impact of quantitative easing, and people sort of switched off gold. And everything that could happen to help gold happened in terms of geopolitics and macroeconomic problems. And gold failed to budge and kept on sliding lower and lower with a little brief recovery rally in 2016. Now, after this secular bull market in equities as a result of liquidity and the markets reaching, particularly in the US, all-time highs, people are again becoming a little bit more nervous. And they are looking at the macro picture, not necessarily only the trade wars, but are looking at the huge fiscal problems, the huge economic problems in main developed economies, and also this geopolitical and socioeconomic uncertainty. We see a lot of unrest in local economic terms from dividing the electorates and dividing the population. So all of these things are building up to a very gloomy and clouded outlook that encourages some investors, at least, to look for safe havens. And gold is, one of the historically most important safe havens. So they have been buying into bullion, again pushing the price up significantly since the middle of this year. One important factor, I believe, has been the buying by some key central banks, for example, China, Russia in response of the sanctions, China in response of the trade wars. Last month, we had the news that even the Central Bank of Serbia bought a record amount of gold to boost the reserves, to diversify the reserves. Now, all of that gold that is accumulated by central banks is effectively removed from the trading place, because these are not people who will sell because the price has gone to $2,000 an ounce. They keep it for the reserves. So any increased interest by the general investment community to buy via ETFs will only add to the demand for gold bullion and push the price higher. And evidence of that is that we are still holding around 1470, 1500 per ounce, even though the equity markets are again at all-time highs. So with any crisis or any geopolitical unrest or any correction in the equity markets, I believe this is going to drive further flows into gold. And ultimately, the rise in the gold price feeds into the profitability of mining companies and could re-rate the mining equities.
But that's that first move of attraction back into gold is going to be through bullion, though, as you said. So not just central banks, but the generalist would move into bullion first, and then would perhaps get inspired by equities and start looking around and start actually being attracted to move back into the stocks.
Well, that has been the initial move for the last 12 months or so. We see the global ETF holdings backed by bullion to have risen to all-time highs. So people clearly want to be in bullion. The question is, when will they get the confidence to go into the mining equities, recognizing the impact it has not only in the profitability, but also in the re-rating of the asset base?
And
do you have an idea when that might be? Or do you feel that we're moving towards that now?
We are clearly moving
Hard to
forward
call,
to that. It is our call. I mean, that's how we are positioned. It has already started happening in the large cap and mid-tier producers that clearly have an immediate impact on the bottom line as a result of the rising gold prices. The question is, when will investors take the confidence to step into the perceived more risky single asset and smaller companies that could have more of a corporate risk as opposed to commodity risk?
Yep. Okay, let's delve into that a little bit in a little bit. Let's keep on the macro themes. Just want to hear from you, Ian, on your thoughts on state of the markets and the macro themes that are perhaps impacting precious metals.
All right. Well, last year when I sat in the same chair a year ago, sort of had the view that it would be a mildly positive year, but nothing particularly exciting, which is roughly how it turned out. This year, I'm actually far more bullish than I was last year about the outlook. And the reason is looking forward to 2020 and looking for an out-of-the-box economic forecast, we think that we're going to see a return to inflation. And that's going to trigger a quite serious realignment out of the trillions and trillions of dollars that are currently invested in the bond markets. US wages are now rising above 4% a year, pretty much the same over here. Chinese wages are rising quite sharply. 80% of the world's manufacturing product comes from China, so if the price of Chinese TVs goes up, it means that gets translated into TVs in the high street over here. The US true money supplies looks like it's finally bottomed out and now starting to turn up again. So there's a lot of forward indicators looking at inflation coming back in 2020. Now, if that happens, if that's true, you only need a tiny, tiny fraction of money to come out of the bond markets and head towards gold. And you could see some quite seriously positive results. So that would be our take on 2020. We think inflation's going to surprise on the upside, catch an awful lot of people out. Majority of economists are still saying there's no sign of inflation. Inflation's dead. Fed's on hold. Not going to get any more interest rate. Interest rates can only go down. During October, we had an enormous sell-off in the bond markets. It just came out of nowhere. I mean, for example, long-dated gilt dropped 10% in a month. The Japanese government bond yield, 10-year JGB, went from -30 to almost flat in a month. That's an enormous move. It's huge. And there's something going on. It's something stirring in there. The money supply, the bond markets, the commodity markets look like they're bottoming out. So,
is that capital rotating into the gold sector, though, or is it pausing?
Yeah, I mean, you know, if you're holding a government bond on a 1% yield or 0% yield or German one on negative yields, and you get inflation back, that just kills that just kills you as an investor. So potentially at some stage you're going to see a panic out of the bond markets, and then the key is, well, where does that money go? You know, and I think if you're looking at the deflation inflation argument turning round in favour of inflation again, obviously a lot of it's going to go into inflation-proof assets. So all metals benefit, as particularly gold, and even more particularly silver.
Larry, welcome.
My view is that the price of gold is very much driven by where we are in the credit cycle and real interest rates. And it's also driven by how well the competitive investments are doing. And until now, the stock market had been doing quite well. And there's a lot of data that shows that a lot of the time gold isn't a particularly good investment, but when the credit cycle peaks and or the stock market peaks, and they both start to go in the other direction, gold becomes an extremely good investment. So like Ian, I'm quite bullish on the price for the next several years, because I think there's a lot of evidence, very clear evidence, that the credit cycle has peaked. We've had 10 years of growth, 11 years of growth since 2008. It kind of fooled all of us. I thought 2008 was it, and we were going to have the crisis right then and there, and we're going to 5,000. Obviously, in 2011, we all learned that that was wrong, and they managed to start another bubble. And that bubble, to me, is very obvious, very clear, and starting to break. And in the United States, we see it in the unicorn land, in the biotechs. We see it in all the high-flying places where the easy money went. And the WeWork story is just a symptom of it. It's almost like a bell ringing to me that this cycle has peaked. And it's clear that in the U.S., the economic data is going in the wrong direction quickly. The stock market hasn't figured that out yet, but it's about to. And as Ian points out, the move in the bond market was epic. And so it's pretty clear to me that the cycle's peaking, and that in light of the cycle peaking, our day is about to come in a big way. And I find it interesting. I think a lot of people looking at gold, looking at the gold stocks, are saying to themselves, you know, this is 2016 again. I don't believe. It's going to be Lucy in the football. They're going to pull it out again. And I think, you know, I'll buy. I've got a lot of people who look at my fund and say, well, I'll buy it when it comes back in a little bit. It's already run. I don't want to touch it. You know, I'm like, guys, you may not get the chance to have it come back in. You know, I think we're going to be at 1,700 very quickly. And at that point in time, I think all these equities are going to re-rate in a major way.
So do you think they're undervalued at the moment, Larry?
Extremely.
Yep. Extremely.
I've never, I haven't been in the gold market for a long time, but I've studied the history. I was a venture capital and financial guy up until 28, and then when, you know, the U.S. government decided to become Weimar, I moved into this area. And obviously, it was a little wrong in my timing. It's taken a little longer than I thought. But I think the end game is still clear and obvious, and that is you can't grow debt in excess of GDP without it eventually having a consequence. It leads to a credit crisis. It's very similar to the 29-30 period. And so I think we're going to have a very serious credit crisis. And at that point in time, all forms of paper become suspect, and 5,000-year-old money works. You know.
But you mentioned there a point about the people you're advising, and they're saying, oh, they're sitting on the fence still. People are still not convinced. And are you talking about junior stocks here? Or are you talking about mid-caps?
Junior and bigger stocks. I mean, 2016, unfortunately, didn't do us any service, right? They took off, and then they collapsed, right?
Yeah, the herd never buys at the bottom, it buys at the top.
Yep.
But I see a lot of value all across the spectrum, large, small, intermediate. I'm absolutely convinced that well-managed funds are going to, you know, in the gold stock space, are going to provide, you know, 2 to 5x returns over the next 5 or 6 years.
Yep. Gentlemen, do you subscribe? What about valuations? Do you feel at the moment?
No, I think valuations. Clearly, we've had quite a big rise this year, but we've the same in the gold price. I don't think we're really stretched yet on valuations. I don't think all companies are cheap, but certainly there's a number of good ones that are still cheap. I think what I think is interesting at the moment is when you think of attracting new money, there's different strategies across this. So I mentioned Barrick, talked to Newmont. They're really, those mergers are around getting to scale so that generalists feel they can invest, and also so they can say, we've got long life assets, we can provide you with 20, 30 years of cash flow, and we're going to pay out some of that in dividends throughout that time. So we're going to pay you a dividend, and we're going to manage long life assets. And we might not grow production very much, but we're going to keep good margins, even increase our margins with economies of scale, and pay out dividends. And that's a very attractive story to generalist investors, which is who they're after. I mean, you go to a generalist and you say, you can invest in a gold company, which is going to provide you an income just at the time when you want it. So when things are going wrong in the rest of your portfolio, when interest rates are falling, I'm going to, show less correlation and probably outperform on the capital side, and I'm also going to pay you an income. And if you can show that long term, that's a very attractive, proposition for any generalist investor in their portfolios. And those large guys, that's what they're going after. Obviously, as you come down then, but that's good for everybody because it attracts more money into the sector, gets more people useful, and then we come all the way down. And that will happen over time. So in some senses, I think, that proposition is now starting to come. What it means is there's still a lot more money that can come in. But we've now got companies at the senior end who can attract that money, and that's good, and they're behaving in a way that I think should attract it. So I think that's very important. Valuation-wise, I think we're still seeing good. I still have worries about the junior space. I'm probably on two things. One, I think quite a bit's changed. I think you have to see Rio's experience. It's not gold, but in oil tolgoi. And they're very vocal about it. They say the problem we have with oil tolgoi is we spent too much getting in. And a lot of the big companies are going, the problem is now with all the regulation, with politics, etc., developing mines takes longer and longer. It's now at least 10 years to get something properly developed. There's lots of risks, so we can't pay too much up front to get in. So the juniors who sit there going, I just need to wait for somebody to come and take me out, you could be waiting a very long time and don't expect a lot of money from those majors because they're certainly not in the mood to spend money up front right now for those projects. The second thing, which I think is coming, and it's certainly we see it in the majors, is the concerns over ESG and reporting on ESG, and that takes a lot of time and effort, and even the majors are struggling, and it's going to be tougher and tougher for juniors to do it, and you're going to have to start doing it. And it takes time and it takes cost. And it's an extra burden on small companies. I'm sorry, it's not good news, but it has to happen. And that's, again, a further cost. The final problem is, for another instance this year, if you look at Vale, Brumadinho, and the focus on tailings dams. The thing out of that as well is companies are now very wary of buying people because they don't know what liabilities they have in those companies. And suddenly people are much more concerned about liabilities. And if you look at what was amazing out of the tailings dams reports we've seen, is companies coming out saying, yeah, well, I've got 130 tailings dams. And you go, you've only got 20 mines. And they go, yeah, but I've got all these legacy projects. Companies are now very wary of buying. So I just think, now if you're a junior with one deposit, that's not a problem. You obviously don't have that history, but I do think you've got to be careful about assuming somebody's going to come in and pay top dollar, because right now they're not going to. That might come in time, but it isn't happening now.
So the strategy for here is hang tight, work on your
I think
capital discipline, work on your...
I mean, it's probably the same as it's always been. You can't just find something and sit there. You've got to come up with a proper development plan and be developing it, because you can't just expect somebody to come and buy you.
And be creative about that exit as well. Sort of look at alternative forms for the time being until the market comes back, until the M&A gets it gets a little bit more.
Yeah, I mean, you've obviously got to develop the project, and I think you've got to be always moving forward with it. You can't just be, if you're sat there waiting for somebody to come buy you, they'll know it, and you won't maximise the value.
Yep. Some really interesting points there, and key points. Does anyone else have any thoughts on perhaps how those are really challenging the space?
Yeah, I think what George said on ESG is a really interesting point. And if you want an extreme example, in the UK, in the FTSE 100, we have a company called Evraz, which is sort of controlled by the owner of Chelsea Football Club, Roman Abramovich, and that currently sits on a dividend yield of 16%. It's in the FTSE 100. It's got a 5 billion market cap because it's involved in coal mining and all sorts of stuff. None of these ESG funds will touch it. And yet Evraz can raise money in the bond market. They could probably issue a bond, 3-4% yield. So that means that Evraz could issue its own bond on a 4% yield and use that money to buy its own shares on a 15% yield. So that's just for the management of Evraz, who don't give a damn about ESG. It's a no-brainer trade. I mean, you just can't lose money issuing your own bond at 3 or 4% yield and using it to buy your own shares on a 16% yield. And I think that's potentially one of the ways what we might see is you get private takeouts of some of these publicly quoted companies, and then they can just, especially someone like Russia, just ignore ESG because they don't really care about it.
Is that a problem with ESG in itself? It's still evolving. It's not worldwide. It's not blanket.
Yeah, but
it's not
uniform. Yeah, the reason the Evraz share price has been coming down is all the sort of green-dominated investors have been selling the stock because they look at it. Oh, it's got coal mining in Russia. Oh, it's got a death touch to it. Yep. But it's now driven the stock down, where it's churning out the most ridiculous dividend yield, which is probably safe. It's not going to be cut.
Angelos, you were going to.
I agree with these concerns about the ESG, but I'd like to return back to the comments, the very valid comments that George made. And I think they are very, very attractive business points of view that go in favor of the larger cap mining companies, that they have cleaned up their act, they have restructured their balance sheet, reduced the debt, managed their operations effectively. They could potentially start returning cash to the shareholders, and this will attract ultimately the generalist investors at that level. The question I have perhaps for some of the mid-tier producers is that the reserve grades keep on dropping. And why do they drop? Because through the bear market years, companies sought to reduce the cost base, to restructure the balance sheet, they cut exploration expenditure to the bone, and they don't replenish what they produce. And that is the key issue, I think, that will drive the management teams to look at single asset companies and engage into corporate activity over the short term. And that clearly is driven by the commodity price, because we were at $1,300 gold 6 or 8 months ago, and management teams were still very cautious and defensive. Now at $1,500 gold, they are spinning out a lot more cash, and their investors will ultimately ask, what are you doing with that cash? Are you simply going to return it to us, or are you going to fund your growth and your declining reserve grades? So I think as a virtue of the gold price pushing management teams and investors to look at the mining space more carefully, there will have to be more corporate activity, and that's when the smaller single asset companies could be re-rated as people look at them carefully.
Yeah, I find it somewhat hysterical right now that all the majors aren't buying every small company that can. I see enormous value in the small companies. I mean, I agree with George, there aren't acquisitions going on, but they could all be doing accretive deals consistently. All the majors have a real serious problem, and that is that they're big, and they've got to replenish what they mine, and they have a hard time doing it in today's world. You have juniors who are actually growing their production very consistently that are trading at 3 times cash flow, and you have majors that are trading at 9 times cash flow. The majors can access the capital markets, the juniors can't. Those majors could buy those juniors and immediately get a pickup in EPS. And yet there's nobody at those majors who's smart enough to think about that and do it now.
Do you think there's still a fear, though, from sort of excessive M&A or sort of bad M&A perceived from
That's absolutely
from
right.
the last
So
cycle?
What they're looking back at is they remember 2011 when, $3.5 billion was paid for, a mine in Africa, and they know that, they've been punished for doing stupid things. But what they've got to think about is where they are in the cycle. I mean, maybe they will come back and maybe they will start buying mines 5 years from now when gold's a lot higher and these stocks have all multiplied by 3 or 4x. They should be buying them right now, but they're not because they're all terrified.
Yep. Any thoughts?
100% agree with that. I mean, but they never buy at the bottom. If gold goes up to 1,800 and 1,900, M&A activity will pick up. If it stays where it is, apparently there's 5 major law firms in Canada, in Toronto, that specialise in M&A in the mining sector, and none of them have any work on at the moment.
Right. Which is stunning to me because there are amazing values out there. I mean, 3 times cash flow. That's a pretty interesting proposition if it's a solid mine.
Much better buy at 8 times cash flow when the price is higher, because they can justify that to their shareholders.
Can I just point out that there has been an early signal of these attitudes actually changing, because some of the mid-cap Australian companies that have seen their paper re-rated far more than the Canadians on the back of the weak Australian dollar, have been looking, funnily enough, to Canadian acquisitions.
Yeah,
Santa
absolutely
Barbara,
right. I should have said, with the
Atlantic.
exception of some of the Australians who figured it out. Yeah.
Yes. So ultimately, by virtue of the capital markets forcing these companies to think about growth, I think it is going to happen. But we need the gold price to stay at 1,500 and above. That's clear.
Okay,
we are price takers in this industry to a large extent.
Let's talk quickly about silver, because we haven't got too much time left, because it's a precious metals panel. And let's get your take on silver, what might be going, where it might be going for the year ahead. Are you quite bullish on it? And also silver miners as well. Ian, I know you're classically overweight in silver.
We're of all the gold funds in the UK, we've got the highest weighting towards silver of any of them. We've got about 60% weighting in silver mines.
What's the thinking behind that? Why do you like
because
it?
if you're a precious metal investor, and if you think you're going to go into a bull market in precious metals, silver has at least twice the beta of gold. So silver will go up twice as much as gold. So if you think precious metals are going to go up, you're much better off buying silver than gold, because it'll go up. If you're not particularly bullish on precious metals, you shouldn't buy either gold or silver. So to us, it's quite a simple uncle. If we get a bull market in precious metals, which is why everyone's here, silver will outperform gold. Almost certain. No 100% certainties in this business, but 99% probability that silver will, and by quite a lot as well, not just marginally.
Let's translate that back to the mining companies. There's not as many silver mining companies out there. How have they performed?
They've done okay. You find that the minute you breathe a bit of life into the sector, the silver mines go up quite a bit more than the gold miners. But we haven't really had a stunning bull market this year. I mean, it's been moderately okay,
right.
But no real fireworks. But if you get the fireworks, you'll see some serious outperformance of the silver miners over the gold miners.
Yep. Any other thoughts on silver? George, less of a bull on silver.
I think I have 2 problems with silver: one with the metal and one with the companies. And I agree a lot with what Ian says about silver being sort of leveraged gold, I call it. And I do sometimes say I've got enough volatility to deal with without adding more. My other problem with silver, and I haven't proved it at all, but it's just an observation, is people used to buy silver. If you go back 20 years, if you wanted to buy physical gold, it was quite hard. We didn't have ETFs. You bought coins, you bought bullion. And if you wanted to put $20 into gold, that was a very, very small coin or bit of a coin or something. It was quite hard to do. But it was much easier to buy a silver coin. It was probably $5 or so at that point. So you could buy silver. People call it poor man's gold, whatever. It was quite easy, small increments in silver. Today, of course, you can buy a gold ETF, physically backed, etc., you can buy $20 of gold ETF shares. It's very easy. So why do you need silver? So, I mean, that's one of my problems is really, is it as attractive as it was? Because essentially, if you can buy gold in those increments, why not buy gold? The second thing I'd say on silver, I did a lot of work on silver back in 2005, I think it was. I was at BHP. We had the largest silver mine in the world, which was Cannington. And we did a long-term study on silver. And all I can say to you is we didn't have a clue. Because if you try and do fundamentals in silver, we did huge amounts of work on recycling of silver out of X-rays as they went digital and all sorts of exciting stuff, photographic use of silver, etc. It was all very interesting, but we came back to one big problem, which was China had a silver standard for a long, long time, and we had no clue how much silver there was in China. All we knew there was a huge amount. And nobody still knows what their stocks are and how much there is there. All we know is there's a lot. And certainly every time when silver went up 50, the big sellers were China. So again, fundamentally, I just don't have a clue. And then I move on to the equities, and my problem with it is generally I look around silver equities and they're not very good companies. They might have some leverage, etc., but generally I see a lot of quite good gold companies, a range of gold companies, but the silver space is much smaller, and I don't find very many good investments. So on all of that basis, I go, yeah, it's interesting, but I can get as much volatility as I want in gold and as many companies as I want in gold. So it's just something I probably, feel I don't need to spend so much time on.
Sure. Okay. Any other thoughts on silver? Angela?
Well, I kind of agree with George on the volatility and the difficulty of finding very good quality silver companies. The reality is that there is only a handful that are primary or exclusively silver producing. They have all diversified into gold, so you get a sort of a mixture of mid-tier producers and some exploration stage companies that are looking for large silver deposits. But the interesting thing about silver is that there is a very clear correlation to gold. And if we look at the gold to silver ratio, which reached an all-time high of 92 times back in June, it has now started coming down. It's currently around 84 times. The long-term, the 30-year average is 66 times. So by virtue of a new cycle developing, we could go way below the 66 times. And that would mean silver prices could shoot up to $30 or $40 an ounce. So it's a more speculative, much more volatile exposure to the precious metals market. But for those people who are convinced about the potential trajectory of the gold price, it could be an added element of performance going forward.
Yeah, the other sort of way of looking at the gold-silver ratio is when the two metals peaked simultaneously in 2011, gold peaked at $2,000 an ounce, and it's currently, to retest that high, it's got to rise 25%. Silver peaked at $50 an ounce, currently around $17 an ounce. To retest its old high, it's got to triple. So if they both go up and retest their old highs, and that will send the gold-silver ratio down to its more historic levels. So if we get a precious metals bull market, silver will go up massively more than gold.
So, sorry, the bull signal for silver will be if Trump loses the next election. If you look at Silver Eagle sales in the States, they collapsed the day he was elected. Guns and silver sales collapsed as soon as Trump was elected because their man was in power and you didn't need to buy those things. So if Trump loses the next election, one would expect to see the Silver Eagle sales take off again. So that might be your bull signal next year.
Do you think he's going to lose the next election?
I'm not commenting.
Okay, interesting. Let's open to the floor. Does anyone have any questions here? Yeah, we've got a question down at the front, Claude, and then we'll come to you. Yeah.
George, thank you for your comments on silver. Since you were mentioning ETFs on gold, there's also ETFs on physical silver, and apparently it's been pretty stable in their terms. When everybody was selling out of the gold ETFs, the silver stock of the ETFs didn't go down much. Does that mean anything? Is there anything there? And then for this very right panel, I know that's a difficult question, but what would be your favorite silver stock?
George, do you want to tackle the first part?
I can't answer the first part. I don't know. And I don't even have a theory, so I won't comment.
Yep.
Favourites, if I'm investing, if I want exposure to silver within my fund, wheat and precious obviously was silver wheat and still has quite a lot of exposure to silver through its royalties, which I think is pretty good. And the other company I like in that space is Pan American Silver.
Okay. When you say you want a silver stock, do you want a sort of blue chip one or a slightly less than blue chip one?
Just a 20 bagger.
Oh, we want a blue chip one. We think one of the biggest quality stocks in the sector, blue chip, is First Majestic. Quite like that one. So. But we like Mag Silver as well.
Yeah, so I'll list a lot of them. So at the high end, I have Wheaton, I have Pan American, I have Mag. I've owned Silvercrest, it's getting expensive. On the more speculative side, I love Alexco. I love Arcana. I think Arcana's a 20-bagger. And that's kind of off the top of my head, the silver names I can think of.
We have the same stocks, so as you said. There's not that many stocks around. So.
Yeah, that's most of the silver miners out there. Covered. Great stuff. We had another question down here. Yeah.
China has about 3 trillion in foreign reserves at present. How long do you think China will be happy with the foreign reserves keeping their value, since they're an asset that's not under Chinese government control?
Well, the Russians were in a similar position a couple of years ago. They had about 600 billion in US Treasury bonds, and they virtually sold them right down to nothing now. And that most of that money's found its way in the gold market. And we suspect the Chinese will do something similar. Now, people think, well, there's no stories around of Chinese dumping US Treasury bonds on the market. They don't need to. Most of their Treasury bond holdings are 0 to 5 years in maturity. So they just simply sit there and let them mature. And when they mature, they don't reinvest them back in the Treasury market. So they're gradually running them down in a way that is not newsworthy, because there's no anecdotal stories around of Chinese dumping billions of US Treasury bonds. The big seller during October of Treasury bonds are the Japanese. They sold 30 billion of Treasury bonds because their own domestic Japanese bond market yields rose. So they're not going to be big sellers. They'll just quietly let them redeem. Their short-term holdings will redeem, and they won't be reinvested in the Treasury market. They'll find their way probably into the gold market.
Yeah, I agree. I think the interesting tell in the Chinese was they stopped growing the Treasury balance in 2013, and it's been kind of flat, and now it's starting to trend down. What I find very interesting about the Chinese is the way they're working to put everything in yuan terms. The yuan gold contract, the yuan oil contract, the direct trade with Russia. You see all kinds of signs of de-dollarization. I think the world is figuring out, and I can say this being in the United States. The United States deficit is out of control. Year on year, it's growing at 40 or 50% a year underneath the top line numbers, if you look at what the real debt number is doing. And it's Weimar kind of stuff, folks. It's a real problem, and that's what's going to make everybody in this room really happy in the next couple of years. It's sad, but it's true. They cannot stop spending. And there's absolutely, you notice the debt ceiling came up a couple months ago. And every time in the past that's come up, there was at least a pretend fight over this being an important issue. Probably, oh, no, we got to cut back. They literally passed it in like 2 hours with no debate, no discussion. Let's sweep this under the rug. This is a very tough subject. We're all good. We're just going to continue to increase the debt. And as the world becomes aware that the reserve currency is being hyperinflated, then they're going to have to look for other choices. And there's a lot of money that's offside. There's a lot of money that's in bonds. There's a lot of money that's in dollars that's going to just get destroyed on a real basis.
Yeah, the Americans aren't going to stop spending, but the buyers of Treasury bonds are going to stop lending at some stage.
Well, that's right. Well, and then what happens when that happens is the Fed becomes the buyer of last resort to suppress the rates, because the U.S. cannot. What we saw with the repo blow up earlier this year is the U.S. can't even handle a 2 or a 3% 10-year. Yeah,
Okay.
I mean, it's just, and that's the tell that allows, I think, a sophisticated investor to see that, bonds are a screaming sell and gold is a screaming buy.
That's a good point and a good one to end on there. We're flat out of time, I'm afraid, and we've got to get into the corporate presentations. But all positive for the sophisticated investor for next year then. So, gentlemen, thank you. Let's have a round of applause for our panel.